On closing bell, let's bring in Lauren Goodwin of New York Life Investments and Eric Wallerstein of Yardeni Research. Good to have you both. Lauren, let me just turn your attention for a moment to Nvidia as well. Like, what do you feel is really at stake tomorrow, not only for the overall tech trade, but the market at large, given the magnitude of the rally we've had back led by tech?
Everything's at stake is the answer. I mean, not just on the upside in the sense that this earnings environment has been really constructive, an important part of the rally so far, but also on the potential downside. I mean, if we look back to the 2000s, it didn't take a big downward turn in earnings to pop the bubble. It took Cisco reporting closer to 50% growth instead of 60% growth to do it. So these numbers matter a lot. If we can pretend that, we don't have to care about Nvidia, which isn't the case, the environment for the rally to continue is quite strong. We've had a good earnings season. We have a Fed that's hell-bent on being dovish, and we have a employment environment that's still very strong. Until any of those factors reverse, which I don't see a reason for that to be the case in the next couple of months, this is a tactical all systems go for the bull market.
Wow, all systems go. So, Eric, the everything rally, as we're calling it, continues?
Yeah, listen, forward earnings definitely are supporting stocks. And as Lizanne mentioned, rising profit margins for the S&P 500. The broadening out with the equal weight index and even, SMID caps is just kind of starting. Small caps are still under pressure from higher rates. But we see no reason with a tight labor market, rising real incomes, and just more spending that corporate profits have to fall anytime soon.
Interesting. So it's going to be an earnings-driven story because you guys are looking, you tend to look out further than most and put out some reasonably lofty targets, I think is fair to say, including one that you put out. You guys put out something big earlier in the week. Remind me what that was. I think it was
so
like
targeting,
Dow 60,000 or something like that.
Yeah, so listen, for the next few years, we have 5,400, which we're nearly at for the S&P 500 this year. And then we're at 6,000 for next year, and then finishing up 2026 at 6,500. And again, that's earnings driven. This whole roaring 2020 scenario right now is our highest probability outcome. We attribute like a 60% likelihood of that. There are some other risks. We have a 20% scenario of a melt up in the stock market. And if the Fed kind of preliminarily cuts, we could see that. Melt ups are fine. You just have to know when to get out. And then there's that 20% scenario where there's another revival in inflation. But for now, we see productivity growth really being a strong driver of real incomes, and for the next several years, driving the market higher. You
don't think what we're currently experiencing is a quote-unquote melt-up?
It's supported by earnings and real incomes, so I wouldn't say that. Valuations could be a little frothy at 20, but there's no reason that that's too expensive for the large caps, especially with what the mega cap 8 have done, including Nvidia.
I mean, it may not be expensive for the mega caps, but 20.5 as a multiple to some seems a little expensive.
Yeah, look, I mean, Lizanne was right. Valuations aren't a great market timing tool, but one of the things we've noticed recently, the past couple of weeks, the equity risk premium has moved negative, which doesn't tell you anything for the next couple of months. As I mentioned, we do think that the case for equity is strong at the moment. But what it does tell you really consistently over a longer term basis, think even 10 years out, that the trade-off between equity and bonds doesn't quite make sense anymore. And so that supports one of our highest conviction views, which you and I have talked about a lot, which is taking some of the gains we've seen in equity, activating it in high yield, where you still get the benefit of the bull market we're seeing, but some higher income stream in the meantime.
What about taking some of the gains you've gotten in cash and use your word, activating it into equities? I mean, that's what some are banking on to get you to that next leg.
We're actually moving cash into short duration fixed income for a couple of reasons. One is that you still have, we think, an interesting risk reward profile similar to the benefit that you would see just putting money to work in equity or other asset classes. But the real reason is that regardless of the path or the exact timeline that the Fed is trying to take, it's very clear that their next move is going to be a cut. And so investors that have benefited from higher rates in cash in the last couple of years aren't going to benefit from those same rates moving forward. And so if you look at the maturity wall in fixed income that's coming in the next couple of years, a 2 to 3 year short duration fixed income play is a really nice way to lock in that higher income stream for the next couple of years.